A notice appeared on the CFTC website. Most people missed it. It was posted after market close, buried in the regulatory announcements section. But the headline should have stopped the world. Emergency Commission meeting scheduled December 19th, 2025, 9:08 a.m., closed session. The topic listed, a market stabilization measures for precious metals complex. That's government speak for we're about to change the rules to save the banks. I've been covering the silver market for years. I've seen manipulation. I've seen suppression. I've seen every trick in the book, but I've only seen this specific move once before. 1980, when the Hunt brothers tried to corner the silver market and the CFTC responded by instituting liquidation-only trading. They made it illegal to open new long positions. You could only sell. You couldn't buy. The rule destroyed the Hunt brothers. It crashed silver from $50 to $10. And now, 45 years later, they're going to do it again. That CFTC meeting on Monday morning, that's not a discussion. That's a sentencing. They've already decided. By Monday afternoon, you might not be able to buy silver on the COMEX. By Tuesday, that ban could extend to ETFs. By Wednesday, it could extend to physical dealers. You have 72 hours. In this video, I'm going to show you exactly what's coming. I'm going to walk you through the 1980 playbook they're using word for word. I'm going to explain why this emergency meeting proves we're winning, not losing. And I'm going to tell you exactly what to do in the next 72 hours before they slam the door shut. This is not a drill. This is the Empire striking back. And you need to be ready. Let me show you the exact notice because the language matters. The CFTC announcement, posted December 16th at 5:30 p.m., reads as follows. The Commodity Futures Trading Commission will convene an emergency meeting on Thursday, December 19th, 2025, at 9:00 a.m. Eastern Time to address urgent matters related to market integrity in the precious metals futures complex. Disclaimer, I'm not a financial advisor. This isn't financial advice, and I'm not affiliated with anyone mentioned in this video. This is purely educational analysis based on publicly available information. Now let me take you back to 1980, because this is not theoretical. We've seen this movie before. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, were billionaire oil tycoons from Texas. In the late 1970s, they became convinced that inflation was going to destroy the dollar, so they decided to buy silver, a lot of silver. By 1979, the Hunt brothers and their associates had accumulated approximately 200 million ounces of physical silver. They also held massive long positions in silver futures. At the peak, they controlled roughly 1/3 of the world's deliverable silver supply. As they bought, the price rose. Silver went from $6 in 1979 to $50 in January 1980. The Hunts were making billions. But the banks, who were short silver, were losing billions. JP Morgan, Engelhard, Makata Metals, they were all short. They were facing insolvency. So they called their friends in Washington. On January 7th, 1980, the COMEX Board of Governors held an emergency meeting. The next day, they announced new rules. Silver Rule 7, they called it. It instituted liquidation-only trading. Starting immediately, traders could only close existing positions. They could not open new long positions. You could sell, you could not buy. The effect was immediate and catastrophic. If you're long silver and you can't buy to roll your position forward and everyone else can only sell, the price has only one direction to go, down. Silver crashed from $50 in mid-January to $10 by March, an 80% collapse in 6 weeks. The Hunt brothers lost over $1 billion. They declared bankruptcy. And the banks, they survived. The CFTC and COMEX justified the rule by saying the Hunts were manipulating the market, that they were creating an artificial shortage, that their buying was disorderly. But here's the truth. The Hunts were buying a physical commodity in a market where the banks had sold more silver on paper than existed. The Hunts demanded delivery. The banks couldn't deliver. So the government changed the rules to save the banks. That's not free markets. That's rigged markets. And they're about to do it again. Let me show you the parallel because it's almost identical. In 1980, Hunt brothers accumulated 200 million ounces. 2025 open interest in silver options and futures represents approximately 700 million ounces. 1980, banks were net short and facing delivery demands. 2025, commercial banks are net short 250 million ounces and facing options expiration on Friday. 1980, physical shortage developing. 2025, COMEX inventory at 92 million ounces, refineries halted, physical premiums at $12. 1980, price spiking to $50. 2025, price at $62 and climbing. 1980, CFTC emergency meeting, liquidation-only rule. 2025, CFTC emergency meeting scheduled, temporary trading restrictions. It's the exact same playbook. The dates are different, the players are different, but the mechanics are identical. The banks are trapped, the government is intervening, and retail investors are about to get crushed. unless you understand what's coming and prepare. Here's what I think they're going to announce on Thursday morning. Let me lay out the probable measures. Measure 1, liquidation-only mode for large speculators. The CFTC will announce that any non-commercial trader, hedge funds, family offices, large speculators holding more than a certain number of contracts, let's say 1,000 contracts or 5 million ounces, will be prohibited from increasing their position. They can only reduce. They can sell or let contracts expire. They cannot buy more. This forces large longs to exit. Measure 2, margin requirements increase to 100%. Currently, to hold a silver futures contract, you need approximately $10,000 in margin per contract. They'll raise it to $50,000 or even the full notional value. This makes it impossible for leveraged traders to hold positions. They'll be forced to sell due to margin calls. Measure 3, position limits reduced to 1,500 contracts per entity. Currently, position limits are 6,000 contracts for silver. Now, let's talk about the legal basis because this is important. How can the CFTC just ban buying? Doesn't that violate free markets? Technically, yes, but the Commodity Exchange Act gives the CFTC broad emergency powers under Section 8A9. It states that the Commission may take emergency action if it determines that an emergency exists that threatens the orderly execution of commodity trading. The law doesn't define what constitutes an emergency. It's entirely discretionary. If the CFTC declares an emergency, they can impose temporary trading restrictions without congressional approval, without public comment periods, without due process. The restrictions can last up to 120 days and can be renewed. This is the legal hammer they used in 1980. This is the hammer they're going to use now. And once they declare an emergency, courts generally defer to the agency's judgment. You can sue, but you'll lose. The Hunt brothers sued in 1980. They lost. The legal precedent is already set. When the government wants to rig the market to save the banks, they can, and they will. Here's what happens hour by hour after the announcement. Thursday, December 19th, 9 a.m., the CFTC meeting begins. Closed session. No media, no public. By 10:30 a.m., the meeting concludes. CFTC chairman issues a press release. In response to extreme volatility and disorderly trading conditions in silver futures, the Commission has approved emergency measures. Effective immediately, position limits are reduced, margin requirements are increased, and large speculators are restricted from increasing long positions. These temporary measures are necessary to protect market integrity and retail investors. 11 a.m., CNBC breaks the news. Talking heads say, regulators step in to cool silver mania. They frame it as responsible oversight. 11:30 a.m., silver futures gap down from $64 to $58 in minutes. Why? Because large funds are forced to sell. They can't hold positions at 100% margin. They liquidate. 12 p.m., retail panic. Silver investors see the price crashing. They think, it's over, the government killed it. They sell their positions, their ETFs, their call options. Capitulation. 2 p.m. By end of day, silver closes at $50, down $12 or 19% in one day. The options expiring Friday are now out of the money. The $70 calls are worthless. JP Morgan and the banks just got bailed out by the government. The gamma squeeze is dead, or so they think. Here's what they're not accounting for. The physical market doesn't care about CFTC rules. Let me explain the great decoupling that's about to happen. The CFTC can control the COMEX futures market. They can ban buying futures. They can raise margins. They can force liquidation. But the COMEX is just one market. It's not the only market. Silver trades in London on the LBMA, silver trades in Shanghai on the Shanghai Gold Exchange, silver trades over the counter between private parties. Silver trades in physical form at coin shops and bullion dealers. The CFTC has zero jurisdiction over those markets. So when they announce liquidation-only mode on COMEX, what happens? The price on COMEX crashes because only selling is allowed. But the price in London, in Shanghai, in the physical market, that price doesn't crash. Because in those markets, you can still buy. In fact, demand increases. Industrial users who need silver can't rely on COMEX anymore, so they go to London, they go to Shanghai, they buy physical from dealers. The buying pressure in the non-COMEX markets pushes the price up, so you get a divergence. COMEX silver trading at 52, London silver trading at 66, Shanghai silver trading at 72, physical silver dealers charging $80, 4 different prices for the same commodity. This is called backwardation in the physical market. This is the market screaming that the paper price is fake. And here's the kicker. Once the great decoupling happens, COMEX becomes irrelevant. Miners won't sell to COMEX at $50 when they can sell to Shanghai at 72. They'll stop delivering to COMEX. COMEX inventory drains to zero. The exchange becomes a zombie market trading paper ghosts with no connection to physical reality. This is the end game. The CFTC thinks they're saving the system. They're actually killing it. Now, let me tell you what you need to do in the next 72 hours. Because this is your last window before the rules change. Action 1, if you hold silver futures on COMEX, you have 3 choices. Choice A, close your position now. Take your profit if you're in the green. Exit before the restrictions hit. You can always re-enter later in physical or through foreign markets. Choice B, stand for delivery. If you're holding December contracts, demand physical delivery. Don't let them force you into cash settlement. Make them give you the metal. But be aware, with the rule changes, they might suspend EFPs. This could trap you. Choice C, roll your position to LBMA or Shanghai if you have access. Get out of COMEX jurisdiction entirely. Move to markets where the CFTC can't touch you. Action 2, if you hold SLV or other silver ETFs, consider this your warning. When CFTC announces restrictions, ETFs might halt redemptions or suspend trading. We're already seeing stress in SLV. The rule changes could be the excuse they need to freeze the fund. If you're in SLV, you exit now or you accept the risk of being trapped. Your choice. Action 3, if you have cash and you're planning to buy silver, you do it this weekend, Saturday, Sunday, Monday morning before the meeting. You go to your local coin shop. You go online to APMEX, SD Bullion, JM Bullion. You buy whatever you can. Because by Thursday afternoon, one of 2 things happens. Either dealers get flooded with panic buying and they run out of inventory, or dealers preemptively raise premiums to $20, $30, $40 over spot because they see the chaos coming. Either way, this weekend is your last chance at normal premiums. And action 4, if you own physical silver and you're thinking about selling, don't. Hold. Because what's about to happen is going to validate everything you believed. The government intervention is proof that you were right. They're changing the rules because the shortage is real, because the banks are trapped, because the system is breaking. You don't sell your winning position right before the other side admits defeat. Let me show you the 3 scenarios for how this plays out over the next 2 weeks. Scenario 1, the crash and recovery. Thursday, CFTC announces restrictions. COMEX silver crashes to $52. Retail panics. Media declares silver bubble popped. But within 48 hours, physical buyers step in. Industrial users realize they can't get silver at $52 because that's just the paper price. They bid physical to $68. Shanghai opens Monday at $74. By January 2nd, the great decoupling is obvious. COMEX at $50, physical at $85. Miners stop delivering to COMEX. COMEX becomes irrelevant. This is the likely scenario. Pain first, then vindication. Scenario 2, the global spillover. CFTC announces restrictions. Thursday, other countries see this as U.S. financial warfare. China responds by banning silver exports entirely, not just restricting licenses, full ban. India raises import tariffs to protect domestic supply. Russia announces silver stockpiling program. The U.S. restrictions trigger a global resource nationalism wave. By New Year's, silver is trading at $120 in Asia, $90 in Europe, and $60 on the zombie COMEX. The dollar loses credibility as a pricing mechanism for commodities. This is the moderate escalation scenario. And scenario 3, the full intervention. CFTC announces restrictions Thursday. Silver crashes on COMEX. But over the weekend, December 21st to 22nd, the Treasury Department announces silver is classified as a strategic material under the Defense Production Act. The government invokes emergency powers. All U.S. silver production is subject to allocation. Civilian purchases above 100 ounces require government approval. This is the confiscation setup. They're creating the legal framework to seize private holdings. This is the nightmare scenario. And after 1933 gold confiscation, it's not impossible. Now, I want to address the psychological warfare they're about to unleash, because the rule changes are just the first move. The second move is the media campaign. Starting Thursday afternoon, after the announcement, you're going to see a coordinated messaging blitz. CNBC, Bloomberg, Wall Street Journal, they'll all run the same narrative. Regulators step in to protect retail investors from silver speculation bubble. CFTC action prevents repeat of 2021 meme stock mania. Silver speculators face restrictions as prices prove unsustainable. They'll interview economists who say silver's fundamentals don't support 60. They'll show charts comparing silver to past bubbles, tulipmania.com, GameStop. They'll bring on experts who say the rally was driven by conspiracy theorists and Reddit manipulation. They'll frame anyone who bought silver as a reckless gambler. They'll frame the CFTC as the responsible adult in the room. This is gaslighting on a national scale. They need you to believe you were wrong. They need you to believe the shortage isn't real. They need you to believe the government saved you from yourself. Why? Because if you believe that, you'll sell. You'll give them your metal at suppressed prices. You'll hand them the physical silver they desperately need. Do not fall for it. When you see the media blitz, remember this. They don't run coordinated national campaigns to stop bubbles. Bubbles pop on their own. They run coordinated campaigns to stop truth. The fact that they're pulling out every weapon in the arsenal, regulatory, legal, media, tells you everything you need to know. They're terrified. You're winning. They're just trying to convince you that you're losing. Let me show you the historical precedent for government intervention backfiring. Because this never ends the way they plan. 1971, Nixon closes the gold window. Says dollar will be strong. Gold was $35 goes to $850 by 1980. 1933, Roosevelt confiscates gold. Says it's for national security. Gold was $20.67, revalued to $35 the next year. Government pocketed the difference. Citizens who held got robbed. 1980, COMEX liquidation-only rule for silver. Silver crashes from $50 to $10. But by 2011, silver was back at $49. The suppression was temporary. 2008, SEC bans short selling of financial stocks. Says it will stabilize markets. Market crashed anyway. Lehman failed. The ban made it worse by removing liquidity. 2020, Robinhood turns off buy button for GameStop. Says it's for customer protection. GameStop was at $400, went to $40. But within months, back to $200. The intervention just delayed the inevitable. Every time the government intervenes to save markets, they're really saving politically connected banks. And every time, the intervention fails. It might delay the reckoning. It might create short-term pain. But it doesn't change the underlying reality. In this case, the underlying reality is a physical silver shortage. You can't regulate away geology. You can't ban the laws of supply and demand. You can manipulate the paper price. You can force liquidation of futures. But you can't make industrial users stop needing silver. You can't make solar panels work without silver paste. You can't make smartphones without silver. You can't print silver. The CFTC emergency meeting is admission of defeat disguised as regulation. Here's what I'm watching in the next 72 hours to confirm this thesis. Signal 1, over the weekend, check if there are unofficial leaks. CFTC commissioners or staff might leak details to the press. If you see articles Saturday or Sunday saying, sources say CFTC preparing trading restrictions, that confirms it. Signal 2, Monday and Tuesday, watch for CME group announcements. They'll likely preemptively raise margins before the CFTC meeting. If you see margin hikes Monday night or Tuesday night, that's the exchange preparing for Thursday's rule changes. Signal 3, watch for bank analyst downgrades of silver. JP Morgan, Goldman, they'll publish research notes saying silver fundamentals don't support current prices. That's them setting the narrative for the crash. Signal 4, watch Shanghai and London premiums. If the premium of Shanghai over COMEX widens from $8 to $15 or $20 over the weekend, that's Asian buyers front-running the CFTC restrictions. They're buying before the U.S. market gets locked down. And Signal 5, watch physical dealer premiums. If you see premiums jump from $12 to $8 or $20 on Sunday or Monday, dealers are pricing in the coming chaos. They're raising prices because they expect demand surge before restrictions. All of these signals will tell you if this thesis is correct. And I'll be tracking everyone. One more thing I need to explain. Why now? Why is the CFTC acting now specifically? Because of the options expiration on Friday. Let me connect the dots. Friday, December 20th, 40,000 call options at $70 expire. If silver is above $70 at 4 p.m., those options are in the money. Market makers have to deliver 200 million ounces. They don't have it. So the bank's called the CFTC. You have to do something. We're facing a delivery crisis Friday. The CFTC says, we'll announce restrictions Thursday morning. It'll crash the price Thursday afternoon. By Friday, silver will be below $70. Your options will expire worthless. You're saved. That's the plan. The timing of the CFTC meeting, 2 days before options expiration, is not coincidence, it's coordination. The regulatory capture is complete. The CFTC is the enforcement arm of JP Morgan. They're not regulating the market. They're rigging it. And they're doing it in plain sight because they think you're too stupid to see it. Prove them wrong. Here's my final guidance for the next 72 hours. If you have cash and you want silver exposure, buy physical this weekend. Anything you can get. Coins, bars, rounds. Buy from local dealers to avoid shipping delays. If your local dealers are sold out, try online. But place orders by Monday at the latest. Because by Tuesday, inventory could be gone or premiums could be double. If you own paper silver, SLV, futures, options, you make a decision by Wednesday. Either you accept the risk of restrictions and potential forced liquidation, or you exit and rotate into physical or foreign markets. There's no safe middle ground. If you own physical silver, you hold. You ignore the price action, you ignore the media, you ignore the CFTC. Because what's about to happen is the system admitting you were right. They're changing the rules because the game was rigged and you figured it out. That's not a time to sell. That's a time to hold tighter. If you're in silver miners, understand that restrictions on COMEX don't affect miners. Miners produce physical metal. If the great decoupling happens, if physical trade's at $80 while COMEX is at $50, miners get paid $80. Their earnings explode. Miners might be the best way to play this if you can't get physical. And if you're on the sidelines watching, learn the lesson. When the government intervenes to save a market, it means the market was breaking. They don't save things that are working. They save things that are failing. And right now, the paper silver market is failing. The COMEX is failing. The bank's manipulation scheme is failing. And the CFTC emergency meeting is the white flag. December 19th, 2025, 9 a.m. Eastern Time, the CFTC convenes. By noon, the rules will change. By close, the paper market will crash. But the physical market? The physical market will do what it always does when governments try to ban supply and demand. It will go underground. It will go offshore. It will go to whoever has the metal and whoever needs the metal. The price discovery will move from New York to Shanghai, from COMEX to back alleys, from regulated exchanges to private transactions. This is not the end of the silver story. This is the beginning of the end of the paper silver story. The physical market is taking over. And in the physical market, there are no CFTC emergency meetings. There are no liquidation-only rules. There's only metal or no metal, supply or shortage. And right now the shortage is winning. You have 72 hours. Use them wisely. This is the last warning. After Thursday, the game changes. Make sure you're positioned on the right side of history. Hold your silver, ignore the noise, and watch as the empire strikes back and misses. Because you can't kill a bull market with a press release. You can't ban mathematics, and you can't regulate away reality. The CFTC is about to learn that lesson the hard way. Enjoy the show. This is the greatest transfer of wealth in modern history, and you're watching it happen in real time. Subscribe.